Welcome to Yahoo Finance Live. I'm Shauna Smith along with Akiko Fajita, and let's get you up to speed on the market action on this Friday afternoon with an hour to go in the trading day. We're not too far from the flat line when you take a look at the three major averages. The Dow and the S&P barely holding on to gains. You can see the S&P moving to the upside, slight upside here after 3 days of losses. The Nasdaq, though, back just below the flat line. If it does close lower today, it'll be the fifth trading day in a row that we've seen the Nasdaq record some losses there. Energy, though, bucking some of the downward trend that we're seeing in the market. We have the XLE up just over 1% today, and that movement to the upside coming as crude prices regain their footing just a little bit, resuming that trend to the upside, settling just above $87 a barrel here at Kiko. So not much movement today, but for the week, though, we know there has been some concern lingering in the market. All three of the major averages on track to close the week in the red.
Yeah, certainly a lot of questions there among investors. We are beginning this hour, though, with Goldman Sachs announcing today a $100 million investment in rural communities. The new initiative is intended to help boost job creation and fuel economic growth across 20 states over the next 5 years. Goldman Sachs CEO David Solomon joining Yahoo Finance from North Dakota earlier today, the first state to receive funding. Our very own executive editor Brian Sazi sat down with Solomon and asked about the new initiative and why Goldman picked North Dakota first.
I think you know that the firm for over 15 years has been incredibly committed to our 10,000 small business program. We've brought the program to over 14,000 small businesses across the country. And the history of the program and the way we rolled the program out over the last 15 years is we went into cities around the country to really increase business education for small businesses. And as we're looking to expand further, one of the things we think is desperately needed is help for businesses in rural parts of the country where they don't have the same access to resources that they might have in some of the cities. And so back in 2021, Senator Kramer invited me out to North Dakota, and we had a good meeting out here where we spent some time talking about small businesses here. We were thinking a lot about what we could do more broadly to expand our 10,000 small business program, and we really saw that there was a real need. You know, when you look broadly across the country and you look at a state like North Dakota and also Arkansas, which is the second state we're rolling this additional program out to that we announced today, 99% of all the businesses in these states are small businesses. You know, it's pretty consistent across the country that small businesses drive a lot of the jobs in the United States. 42% of all employment in the United States comes from companies that employ less than 50 people. And so as we wanted to expand 10,000 small businesses, we thought we should develop a program that could really support it in rural communities. We decided to start with North Dakota and Arkansas, but we certainly have plans to roll it out to other states shortly, including South Dakota and other states in the Midwest that we're targeting. We've done a bunch of research. We've had about 75 meetings to look at where we think there's need. And we're excited that this $100 million commitment today, which $75 million goes to fund CDFIs, $15 million to fund the community colleges that support the educational effort, and $10 million to make capital more accessible. We think this is a good start to expand the program rurally, and that $75 million of grants to CDFIs brings our total commitment to CDFIs through this program up to $1.6 billion. So we think this can continue to have a broader impact on small businesses across the country. That generates, obviously, economic growth, and we think it's very important for the economic ecosystem of the United States.
I talked to your chief economist, Jan Hatzius, at the tech conference. Now, he lowered this week his recession odds from, believe it was from 20% to 15%, so a little bit better there. But when you talk to small businesses, are they still worried about a recession? And how, what's the economic vibe from that small business customer?
Sure. So Jan did lower his economic prediction for recession. There's no question the U.S. economy has been a lot more resilient over the last 12 months than we would have expected. And I think the chance for a softer landing right now is much higher than we would have anticipated a year ago. That said, small businesses feel the brunt of inflation, higher interest rates much more directly than large organizations. They don't have the flexibility or the nimbleness or the resources to necessarily brave those headwinds so quickly. I think we all know that the pandemic was devastating to small businesses across the United States. A lot of them are service businesses that definitely lost their ability to serve customers during the pandemic. They had to save more aggressively to keep their businesses growing. And so small businesses have definitely had a bumpy ride over the course of the last few years. There's no question, as the economy's done better, they are experiencing this softer landing environment, but they definitely have more headwinds than the larger enterprises across the country.
If the economy has hit that soft landing position, David, what is your outlook for that bread and butter investment banking business over the next 6 months? Of course, a lot of excitement around the ARM deal, Instacart, you name it. So we're starting to see some big names in that private market come to public market, or at least very soon. Do you see that IPO market and the investment banking business starting to turn around?
Well, we've been through a really tough year for capital markets activity. We went from a very robust environment in 2021 to obviously a much different environment after the war in Ukraine started. And obviously, very, very high rampant inflation, a very significant change in posture from the Federal Reserve. If you go back and look at Powell's comments, a year ago at Jackson Hole, that decreased confidence significantly. And of course, that closed down M&A activity and capital markets activity. And that activity really in the first half of this year was pretty anemic. We are starting to see a pickup in activity. As you mentioned, there are some very significant IPOs that are in the market this week. The ARM IPO is progressing nicely. And I do believe that if these IPOs go well, that kind of creates a virtuous cycle of bringing some of the other IPOs that are in the wings waiting to market. And so I do see a pickup in capital markets activity during the course of the fall. I can't say that we'll get back to what normalized levels are, but we're really coming off of, zero activity. And so we're encouraged by what we see. And obviously an environment with more capital markets activity is a good environment for Goldman Sachs, given our position in those businesses.
This pickup in investment banking, good to see. I mean, it's long overdue, but it comes at a time with increased tensions between the U.S. and China. And I hope I got this right. I think Goldman opened its first office in China in 1994. I hope I did the Yahoo search right. Apologies if I did not. Nonetheless, you do business in China. How concerned are you about these increasingly frayed tensions between these two big economic superpowers?
Well, there's no question that the bilateral relationship between the U.S. and China is something that's getting an awful lot of focus. I thought Secretary Raimondo did a terrific job in her visit, delivering some very, very important messages. We're significantly intertwined with China economically, yet from a strategic perspective and a security perspective, we have some very, very important things that we need to move forward to rebalance some of the relationship that we have with China. That obviously, that tension and some of those issues, as we work through them, those are headwinds to growth. China's economy at the moment definitely seems softer. That's something that we're attached to. If China catches a cold economically, we're probably going to feel some headwinds to economic activity because of that. So this is something that we all have to watch very closely. But I'm pleased, with what I see in the dialogue. But this is going to take some time to sort out.
1 year ago, I think it was about 1 year ago, we were talking about your latest 10,000 small businesses. I think it was a DC event. Now, fast forward to today, Goldman's a different business. You've pulled back in the consumer area, that more mass market is. Are you totally done in mass market? Do you ever see yourself maybe making a return there at some point once you've made some of these exits more recently?
Well, we built a very significant deposit platform in Marcus, and we continue to be in that business. We'll continue to take deposits from the mass market. Our Marcus platform has over $130 billion of government guaranteed digital deposits. We pay a very, very attractive rate, I think, to depositors in that platform. We still operate our credit card platforms, but we have scaled back some of our ambitions to be a larger direct-to-consumer platform. And we're really focused on our two principal businesses, our leading investment banking and markets business, which is about 70% of the firm, and our broad global asset and wealth management business, where we supervise $2.7 trillion of assets and are the fifth largest active asset manager in the world. We see an enormous growth opportunity for the firm in that area, and we're very focused on it. So that's where the lion's share of the firm's focus is at this point in time.
Would there ever be any interest in acquiring a smaller, getting into the community banking? If those acquisitions came up, certainly a lot of opportunities presented themselves earlier in the year. Is that something that would interest you as a way to more quickly get back into that space?
Where our focus, our strategy is clear. We articulated in our investor day in early February. We are focused on our investment banking and markets business, our primary muscle group. We have a leading franchise in the growth of our asset and wealth management business. There'll be other things that we touch on, but those are our primary focus at the moment. We have we have no plans to make an acquisition of a community bank or a banking institution at this point.
Fair enough. And David, there's been a lot of just, you saw this coming. There's been a lot of just strange stories about Goldman Sachs. And I think Yahoo Finance, that our community doesn't really care about any of this stuff. They want to know how your stock is going to do, how your financials are going to perform. But you as a leader, as you look back over the past few months, how have you changed? Do you see a better path to just sentiment on your leadership and the culture inside of Goldman Sachs?
Well, I wake up every day focused on Goldman Sachs, and I wake up every day thinking about, with my management team, my broad management team, and I'm very fortunate to work with an extraordinary management team across our management committee. I'm very focused on how we serve our clients, serve them with excellence, serve them with distinction, and how also we deliver for shareholders. We're coming up on 5 years this month, and if you look at this leadership team and the work we've done over the last 5 years, we've performed for our clients, we've grown our business, we've performed for shareholders. That's what our focus is on, and we tend to stay focused on those things. That's the discussion inside Goldman Sachs.
When you sit with investors and you sit with clients and you look them in the eye, do they still have confidence in a Goldman Sachs?
I think our clients have enormous confidence in Goldman Sachs. The feedback from our clients around Goldman Sachs and the work we do for them continues to be very, very strong. We wake up every day dedicated to serving our clients. I think we do it with excellence. We do it with distinction because of the extraordinary people that Goldman Sachs has all over the world. And so we feel very, very good about our client franchise, but we don't take it for granted. We invest in it every day. And I'm very confident that if we continue to serve our clients with distinction, Goldman Sachs will continue to grow and will continue to thrive, just as it has for the last 150 years.
Goldman Sachs CEO David Solomon speaking to our very own Brian Sozzi there. And Shana, David Solomon sort of hinting at some optimism to come when you look at the IPO market. Certainly a very big business for Goldman. When you think about investment banking, revenue was down about 20% in the last quarter. He talked about ARM, and that is sort of the big one that I think the market is watching closely, just given the valuation that it's expected to command, roughly $50 billion. The FT now reporting that the deal is 5 to 6 times oversubscribed. And I thought it was interesting that David Solomon said that could create this virtuous cycle, especially given just how anemic the IPO market has been over the last year.
Yeah, anemic was the word that he used, and he's exactly right. We've seen a slight pickup here in activity this year when you compare it to 2022 levels, which was among the worst that we've seen in decades. But yes, he was saying that if we do see a warm reception on the street to ARM, there's also a lot of anticipation about Instacart. We're getting reports here that they could start their roadshow as early as Monday. If we do see a warm reception to ARM, if we do see investors interested in Instacart, yes, that would signal that maybe the IPO market is picking up steam and we could expect more of a pickup in the later half of the year and then, of course, into 2024. But he was talking about everything that's been holding the IPO market back, right? When we talk about an aggressive Fed in the midst of high inflation, in the midst of this higher rate environment. So unless we see a material change on that front and are able to avoid a recession, if inflation does continue to come down, if the Fed holds off on raising rates and then potentially eventually cuts next year, obviously at some point next year, that obviously would bode well here for the IPO market. We know that it's so important here to Goldman Sachs' business. So clearly, David Solomon wants to see ARM and Instacart do well because, of course, that could signal a real pickup here in activity.
And we should point out there's a special focus on ARM, largely because of where we have seen the market go. Chip maker, chip designer out of the UK. We've seen chip makers really rally on the back of the potential for the revenue that could come in from artificial intelligence. When you think about IPOs overall, though, it's not necessarily that we haven't seen them. We've talked about Kava a lot. They had a huge debut, a number of other names that have come to market that have done pretty well. Renaissance Capital, which puts out some pretty good data always on the IPO market, saying they're expecting 30 to 50 more IPOs by the end of the year. But ARM could be that trigger, to your point, because it is a big tech IPO. Instacart could follow. And the hope is that really gets the ball rolling on a number of other IPOs. It's going to be interesting to see for me with ARM where that price lands, largely because of also what's riding for SoftBank and their roughly 90% stake in the company. So a number of threads there, but the market watching are very closely.
Total proceeds so far this year, this is the latest out of here from Renaissance, totaling $9.9 billion. So a massive gap when you compare it to those 2021 record levels there, but a bit of an improvement when you compare it to 2022. So we'll see what's in store for ARM and Instacart and whether or not it's enough here to reignite the IPO market.
Yeah, we'll certainly all be watching that one. Well, let's do a quick check of the market sponsored by Tasty Trade. The S&P 500 right there, just sort of teetering at the flat line there, up about 0.2%. The Dow up 15 points there. And the Nasdaq, the only one in the red right now, although just down slightly. Also taking a look at the VIX, the fear gauge, as we like to call it, down about 2.6% right now.
All right, well, we are just getting started here on Yahoo Finance Live. Coming up, Google is headed to court facing off against the Justice Department over antitrust charges. We're going to have more on what to expect next. Plus, President Biden arriving in India for the G20 summit amid rising global tensions. More on that later in the hour. And with the NFL season underway, we are going to speak with DraftKings CEO Jason Robbins about what could be a record-setting year for the sports betting industry. All that and more when Yahoo Finance returns.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
Now I got a question. What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again. Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
It's not enough to know what's happening now. You need to know what's happening next.
I'm Dan Howley, and this is What's Next with Samsung.
So you can put it in the water.
That's pretty gnarly.
Water.
This is the heart and soul of Astrobotic. This is where we build our landers up to go to the surface of the moon.
Is the future high power, bigger boats? How easy is it to take the battery out, do the charging thing?
Imagine being able to charge without ever plugging in. It's becoming a reality thanks to technology that's hidden beneath my feet.
We'll show you what tomorrow will look like today. Join us for our new series next.
Stocks mixed today as the Nasdaq looks to shake off a 4-day slide. Tech stocks among the hardest hit this week amid rising geopolitical tensions and also fears of an even more aggressive Fed. We want to bring in Phil Orlando, Federated Hermes Chief Equity Strategist. Phil, it's good to see you. So certainly we have seen investors shun some of these more riskier assets here over the last several trading days. When it comes to tech, though, we have seen some losses, but are we headed for an even larger correction ahead?
I think the answer is yes. First of all, thank you very much for having me. One of the things that we've been focused on has been the significant divergence between the performance of these big 8 technology companies and the rest of the market over the balance this year. The stocks I'm talking about are, Apple, Microsoft, Amazon, et cetera. These 8 stocks collectively account for 28% of the weight of the S&P 500. Now, the first half of the year has been terrific for the S&P. You're up about 20%. These 8 stocks, these technology names, collectively are up by 65% in the first 7 months of the year. How are the other 492 companies doing in the S&P 500? They're up about 7%. So we think there's a significant divergence that's been created from a valuation perspective. I'll just give you one example. NVIDIA is sort of the poster child of this imbalance. From the bottom of the market last October to where NVIDIA's peaked out, over the course of the last month or so, the stock has gone up by a multiple of 5 times. From a valuation perspective, they're trading at something like 40 times forward revenues and 130 times forward earnings. That, in our view, is excessive, and it's reminiscent of what the tech stocks did in that fourth quarter of 1999 as we were going into the Y2K calendar changeover. So we've been expecting that the technology stocks would have some profit taking, in this August, September, October timeframe. You've seen some sloppiness over the course of the last, couple of weeks or so. We think this continues over the next few weeks and next few months. And in the meantime, we think some of the value stocks and small cap stocks and international stocks are probably going to feel some love.
So Phil, you talk about profit taking. I mean, let's look at one of those names that we just had up on the screen there, Apple. We have seen some declines on the back of those headlines coming out of China. There's an argument to be made whether, the sell-off we saw over the last few days, although a bit of a bounce back today, how much of that is overdone? Are you concerned that a headline like that could really start to unravel some of this tech trade, or is this just an overreaction in a very jittery market?
Well, look, the reality is these stocks have done phenomenally well since the bottom of the market last October and the first, 7 months of this year. So given where we are in the calendar and given how excessive valuations are, investors are looking for, some justification to lock in profits. And certainly the news out of China with regard to Apple and the concerns about how well or how poorly this new product transition is going to go. I guess they've got a new phone they're going to announce on September 12th. Some investors saying, you know what, let's take some chips off the table. Let's play with the house's money. And so that's a perfectly rational viewpoint for a lot of investors. Now, is this a phenomenon that just lasts for a couple of days? Our best guess is that this phenomenon could last for a couple of months. The August, September, October period historically is a choppy one. This is the sort of thing we see every year. The fundamental setup is very similar to what we've seen in the past. So we went into this period thinking cautiously about domestic large cap growth and technology in particular. We're underweight those categories. And this is the reason. We do think they'll pull back. Not that these are bad companies. Look, Apple's a phenomenal company. Softy and NVIDIA are phenomenal companies, but I'd love to get back in overweight a little later in the cycle at much cheaper prices.
Phil, when we talk about the fact that tech is still not attractive to you at these current levels, that pullback, though, I guess, how large of a pullback do we need to see, or do you need to see, in order to feel a little bit more comfortable getting back into some of these names?
Sure, that's a great question. So the S&P 500, looking at this more broadly, from the bottom of the market last October to where we peaked out recently, is up 32%. It's a little overbought in our view. Now, we're not looking to go back and retrace to the bottom of the COVID pandemic back in 2019 and 2020. That's not what we're talking about. But up 32% in the last 8 or 9 months, up 20% this year. Could we pull back 8 to 12% over a period of a couple of months here? That to us seems like a reasonable level. We're probably down about 5% or so over the last month or so. So we could see a little bit more pain. But at the same time that some of these tech stocks are going to succumb to some profit taking, there are other sectors in the market that are doing really well. I mean, look at energy, for example. Energy prices, crude oil, gasoline, et cetera, probably up 25, 30% here over the last couple of months. Energy stocks are doing pretty well. And those stocks were left for dead as these technology stocks were doing really well. Energy stocks trading at single-digit PEs with 4 or 5% dividend yields, with the S&P 500 dividend yield at about 1.5%. So there are pockets of the market that are still attractive here, and I think investors right now are grappling with that trade-off.
Yeah, we have seen so many guests who have come on the show to talk about the opportunity in energy right now. Let's look ahead to next week. We're going to get some key inflation data, which is likely to play a big role in the Fed's decision on whether to keep rates higher for longer. What are you expecting out of CPI data next week?
So there's no question in our mind that inflation peaked last year and is coming down. The question is the pace of the decline. And I think more importantly, the question is the dichotomy in the pace of the decline between headline or nominal inflation on the one hand and core inflation on the other. It's the Federal Reserve that's looking, at that core number. The core PCE, for example, Personal Consumption Expenditure Index, which is what the Fed's primary focus is. The decline in nominal inflation has come down more than 4 times as fast as the core inflation. So that's point number one. Point number two, we just talked about energy a moment ago. Crude oil, gasoline prices are up 25, 30% over the last couple of months. That's going to start to manifest itself in headline CPI inflation. So when those numbers get flashed next week, we think we're actually going to see an increase in CPI inflation. I'm not sure if the market's prepared for that. It's going to take a while. Remember, energy is not one of the areas that's included in core inflation. Core strips out the food and the energy prices. But if headline inflation goes up, which sort of bucks the trend of this, rather significant decline that we've seen over the last year, that may cause investors a little bit of a pause. We think the Federal Reserve is going to remain hawkish. You talked about, higher for longer, and frankly, that's our call as well.
So, Phil, then what do you think, if you don't think the market's prepared for higher inflation potentially next week, what has already been priced into the market up until this point?
Well, the market, if you look at, the WIRP page on the markets right now for interest rates and Fed policy decisions, there is a significant cross current that's going on. Up until just recently, the market's view was that we had immaculate disinflation and an immaculate pivot, that the Federal Reserve was going to turn around and start cutting interest rates, now. I think that Federal Reserve Chairman Powell, at his Jackson Hole speech a couple of weeks ago, was able to successfully dissuade the market from thinking that. They now understand that, okay, we may get a pause in September 20th, the next FOMC meeting. We're pricing in another quarter point rate hike on the November 1st meeting. Maybe the Fed pauses at their mid-December meeting, and then they announce that, okay, we're sort of on pause for a while. That becomes our terminal rate. Let's say the upper band's at 575. We think the Fed's going to stay on pause until the back half of next year, like maybe this time next year before the Federal Reserve begins to actually cut interest rates. That's not in the market. The market believes that the Fed's going to turn around and start cutting interest rates, if not today, then certainly by the beginning of next year. And so that if the market begins to appreciate the reality of where we are with both inflation and Federal Reserve policy, then that could contribute to this, little bit of a correction we've been talking about over the course of the next couple of months.
Phil, always great to talk to you. Phil Orlando, Federated Hermes Chief Equity Strategist. Thanks.
Thank you.
Google and its parent company Alphabet are set to face what could be their toughest legal challenge yet, a trial against the Department of Justice. In 2020, the DOJ sued Google, saying it had broken the competition law by illegally blocking competition in the online search market. Yahoo Finance's Alexis Keenan is here with what to expect. Alexis.
Hi, Kiko. Yeah, so this trial, it kicks off on Tuesday, and it is going to happen in the Federal District Court for the District of Columbia, as you said, brought by the Justice Department, but also by 30 plus U.S. state attorneys general. And they say that Google is abusing its monopolies in the markets for there are three of them. It's search engines, search engine advertising, and search engine text advertising. Now, take a look. In 2022, search advertising generated more than $160 billion in revenue for Google. That's more than half of the company's $280 billion in total revenue for the year. And in terms of volume, Google processes almost all of the searches in the US. They process approximately 89% of all searches on mobile alone. Take a look at that. It's a growing market of concern for the DOJ and the states. In that respect, they process 95% of all search queries online. The next largest competitors in search, Microsoft's Bing at 6.4%, and you can see there Yahoo's affiliate company, Yahoo Search, at 2.3%. Globally, Google has less of an advantage at 83% and Bing at 9%, Yahoo at 3%. Also, DuckDuckGo is in there at just under 1%. So what the government say is illegal here are contracts that Google enters into for computer devices, mobile devices, also browser services, browser developers, and also wireless carriers. These contracts, they require Google Search to be the default programmed into these devices. And some of those companies that enter into these contracts, they're the common names, Apple, LG, Motorola, Samsung. On the U.S. Wireless carrier front, AT&T, T-Mobile, Verizon, also browser Mozilla. So Google here, they're not challenging that they actually have monopolies in these markets, but instead what the company says is that their conduct in these markets, in these monopolies, isn't harming competition. That's the key there. But largely, these complaints are saying that it's Google's search, its main search function, that is allowing it to also grab these advertising dollars. But the fundamental here is the search. And in the complaint, it's very telling that the DOJ in the states, they call it the cornerstone of Google's entire empire. Guys?
A lot riding on this case for both sides. We'll all be watching. Alexis Keenan, as always, thanks so much for that. Well, coming up, President Joe Biden landing in India ahead of the G20 summit this weekend. We're going to discuss what's on the agenda of this gathering of world leaders and why China's Xi Jinping is opting out of the gathering altogether. That's all ahead on Yahoo Finance.
The Nasdaq trying to snap a 4-day losing streak. And while heavy hitters like Apple have come under pressure this week, it's not all bad news. Jared Blickery joining us now from the floor of the NYSE with a look at some of those winners within the tech sector. Jared, who's bucking the downward trend?
That's right, Shauna. It's not all about the AI trade. Let's go to the Wi-Fi Interactive, and I will show you the winning and losing sectors for the week. Not a lot of winners here, and they are small at that. Energy and utilities in the green there. But what's really catching my eye is who's losing. Number one is industrials, followed by materials. And I think that's really a story about the US dollar being strong. And then XLK, that is the tech sector, and we're going to focus on that here. As we know, we've been talking about the Apple China story all week. That has cast a dark cloud over the semiconductor, which you can see here. This is over the last 4 days. A couple of green spots. Guess who those are? Intel, Global Foundries. Intel could potentially benefit from its doubling down on foundries in the US, eventually making up ground where others may lose. I think that's just the least bad, it's a case of being the least bad, what is it? Shirt in the laundry basket, least dirty shirt in the laundry basket. Then you take a look at software. Software is mainly green here, and I think that's really a story about strength in cybersecurity as well as the cloud. Even Microsoft, which is also an AI stock, has a lot of offerings and a lot of leverage with respect to the cloud. So I think that's what's going on there. And you take a look at some of the winners here. We got Snowflake up 5%, we got Path up 16%, CrowdStrike up 4%. So the list goes on. But just getting back to some of the sector action and what it means with respect to the price action that we can see in the weeks to come here, I mentioned the strong and rising dollar. Let's take a look at that, which has been casting a shadow on the cyclicals like industrials and also some of the material stocks. Here's the US dollar index over the last 3 months, and that is almost a straight line from the lower left there in early July or mid-July all the way up to September here. That is up to the upper right. In the grand scheme of things, that is a tiny, tiny move. You can just barely see it in that red circle here. But nevertheless, it doesn't take a big percentage move to have reverberations from the currency market into the equities market. Also want to take a look at longer term rates. Those are going to be front and center next week when we get that CPI reading. That's going to, whatever the market reaction there, it's going to be expressed probably most clearly and deliberately in the bond market. So here's a 10-year T-note yield. That is up this week, just a smidge, but you can see really close to these multi-year highs. In fact, the highest levels that we've had since 2007. This typically drags on the tech trade as well as some of the growth trade, but we really haven't seen anyone benefiting that much from the interest rate structure or even the dollar structure other than energy. And I should note that energy is a reflection of crude prices, which are rallying in spite of the increasing dollars. So that means that the crude trade is all the more important to watch. Back to the main point, tech had a pretty good week given the developments that we've seen with Apple and with also the AI trade kind of fizzling out there. Here's finally a look at the Nasdaq 100. Clear standouts are Apple, Nvidia, but you move beyond that and some of the semiconductor names, actually a pretty good week for the Nasdaq 100 overall.
All right, Jared, lots of movement within some of those tech names. And I guess if we're seeing some weakness in Apple and Nvidia, it doesn't necessarily mean we'll see weakness there across the board. Jared, have a good weekend. Thank you.
You too.
Well, President Biden kicking off a 4-day trip to Asia today, meeting with Indian Prime Minister Narendra Modi ahead of the G20 summit this weekend. The two leaders pledged cooperation on everything from infrastructure to technology. Economic cooperation also expected to be at the top of the agenda when world leaders gather in New Delhi at the summit. But there will be one glaring absence, with Chinese President Xi Jinping opting not to take part in the G20 discussions. Joining us now is Josh Lipsky, a senior director at the Atlantic Council of Geoeconomics. And Josh, to be clear, China will be sending their premier, but Xi Jinping not taking part in the summit this time around. What do you make of his absence?
Well, it's a very significant move for Xi Jinping to not be at the G20. And just to put this in perspective, it's the first time he's skipped a G20 since he became president in 2013, but also the first time any Chinese leader has skipped a G20 leader summit going back to Hu Jintao, and the leader summit began in 2008. So the fact that China is not sending the head of government, Xi Jinping, to the G20 is more than just a China-India story, a China-US story. It's a China global engagement story. And we can't say enough about what it means in the wake of the BRICS expansion 2 weeks ago.
This, of course, comes at a time when there's global concern about what's playing out within China and its economy. Yes, there's still growth, but slower growth. And certainly the latest economic data points to further pullback. How do you think the President Biden sort of goes into these discussions in the absence of Xi Jinping?
Well, you asked such an interesting question because had Xi gone, he would be walking into the G20 with the weakest Chinese economy of any Chinese leader since the G20 began. I don't think that's why he skipped, but that was one complicating factor for him. And meanwhile, the U.S. economy is doing better than many expected. You could have U.S. GDP at close to a 1-to-2 ratio of Chinese GDP, outpacing the Eurozone in the U.S. And so President Biden comes in a much stronger footing from where the U.S. economy was expected to be a year ago versus where the Chinese and other economies are at the G20. It's one of the strongest stories to sell amongst the G20 economies.
Does this provide an opening for the U.S. in some ways? You know, we've been talking so much this week about the tech policy and the tensions we have seen between the U.S. and China. Apple sort of being the very latest to be caught in the middle here. But the U.S. has been trying to rally other economies around its own agenda to counter China's growth in the space. Is there an opening here for the U.S. given the absence of the Chinese leader?
Well, it could be a big strategic mistake for Xi not to be there. First of all, the BRICS are hosting the G20. So India this year, Brazil next year, South Africa the year after. So that signal alone for him not attending reverberates beyond India to the future host of the G20. And it is an opening for the US and the West, but they have to capitalize on it. And I have to say, so far, you see a strategy by President Biden to fill the gap left by Xi not there. We've already seen in just the last few hours a series of announcements between the US and India, a lot of messages going back and forth about the significance the US places on this G20 summit and how excited the president is to be in New Delhi. This is not a coincidence. Some of this would have happened if Xi had been there, but it might not have had the exact same tone and feeling given that he's not there.
How do you think India capitalizes on being the host here? This comes at a time when there's a lot of discussion about India being the next big opportunity, at least from an economic perspective. American companies, multinational companies who are becoming a little wary about what's playing out in China, looking at India as another opportunity. How do you think Narendra Modi capitalizes on that interest?
Yeah. And that has been such a goal of this entire G20 process for Modi and the entire Indian government. This has been a year-long event for them that caps off this weekend. It's been a national event. They have put more into this G20 than I really have ever seen a country put into a G20 process. And specifically because of what you said, Akiko, wanting to show themselves for the world, for investment, for business opportunities. But so much has to happen in order for that to actually materialize. We know there's interest from Apple. We know there's interest from companies all over the world. But the difference between that and large-scale investments, confidence in rule of law, confidence in business investment practices, there's still a lot of work to be done. So the G20 is really just the start of the Modi strategy. You're going to have to see it play out, and it's going to take years.
Finally, Josh, since we have you here, I got to ask you a central bank policy, putting your former IMF cap back on. We've been talking a lot about where the Fed policy is likely to move, keeping rates higher for longer. I know you've been watching the ECB, the BOJ, where things are right now. How do you make sense of global central bank policy right now and where inflation is in this higher rate environment?
One big takeaway for me from Jackson Hole, and I love to talk about central banking, so thank you for asking, was the humility shown by the central bankers recognizing we don't quite understand the policy environment we're operating on it. And they were very upfront about that, the Fed, the ECB, even the BOJ. And I think that's needed because clearly the models have not planned out and they have to recognize going forward, this is not going as expected and you don't fully understand the tightening effects in this post-pandemic economic situation. And I think that means you're going to have a more cautious central bank across the big four than you might otherwise have with these economic factors. I think the ECB still has more room to hike. I think the Fed is going to pause sooner. I heard your previous speaker. I think that they're going to pause sooner and let these monetary lags play out. The bottom line is you have to give a little bit of a breather now, given the rate cycle hike we've been through, because you don't fully understand the ramifications. The old models just aren't working.
The Atlantic Council's Josh Lipsky. Always good to get your takes here. Really appreciate you joining us on this Friday.
Thank you.
Still to come here on Yahoo Finance, we're talking the state of the online sports betting industry with the CEO of DraftKings as the 2023 NFL season kicks off. Stick around.
Podcast Network, Podcast One, going public today on the Nasdaq, a spin-out from its parent company, Live One. But the stock under pressure on its debut, off nearly 50%. We want to bring in Rob Ellin, Chairman and CEO of Live One and Podcast One. Rob, it's good to see you. Congratulations on the public debut today. Obviously, you're going public in a very difficult time here for the market. We were talking earlier in the show just about whether or not we're going to see a little bit more activity when it comes to public listings. But when you make the decision to go public now and you did this via a SPAC, why did this make sense for your company?
Sure. Great question. And this wasn't a SPAC. This is actually the first time ever done in history where it was a spin-off of a minority stake.
Oh, apologies.
So we uplisted our stock. And the reason that we did it is and we started this process almost 8 months ago. It got delayed a little bit by Nasdaq. By the time it finally got done, we had already achieved a lot of our goals. And one of those goals was to acquire additional podcast networks. So this is that kind of perfect storm in podcasting. You had this wild cycle. Spotify, Apple, iHeart spending billions and billions and billions of dollars at, big multiples, right, to acquire both individual podcasts, whether it was Joe Rogan or it was buying networks or buying technology. Now is that opportunity where there's a window where a sophisticated management team like ours, who has the history of doing this, the history of doing it in radio, and now in podcasting, could acquire and roll up multiple podcast networks. So we've bought a distressed asset called Cast Media, very distressed, troubled asset, owed a lot of money to its podcasters and couldn't really afford to pay them, and the banks pulled out and debt holders pulled out. So we acquired those and have added some very serious revenues to it. So this morning we announced, as part of the uplisting, we increased our guidance from 34 million last year to this year being 47 to 53 million. And for the first time, I have a very serious EBITDA for $4 to $5 million of EBITDA. So dramatic turn for the company. And I fully expect to use that currency going forward for additional acquisitions.
Rob, on that point that you made about where the podcast industry is, I mean, it feels like there's a bit of a shakedown that's happening. You know, there were some big names that were acquired, especially for Spotify. We were talking about Meghan Markle's podcast, for example, earlier today, that haven't necessarily performed well. Are we at a saturation point? How would you characterize the state of the industry right now?
The beginning of the beginning. We're really in the first, maybe second inning of podcasting. It's grown since COVID from 400 million to 1.3 billion. But from all the numbers are indicating globally, it'll be a $7 to $10 billion industry by 2030. So you're going to go through another cycle. You went through that first cycle, right? Real enthusiasm and excitement. Now you've got to pull back because people they'd acquired all these assets. They have to figure out how to run them. It's really complicated just to acquire them and not know how to deal with creators. What I think we're best at is we're a creator-first platform. Building really serious relationship with those creators and giving them a full 360 play, everything from marketing to production to sales across the board. And then we have this massive distribution network that crosses over Apple and Spotify and iHeart and Samsung TVs and OTT channels. And I think we're just going to continue to expand that network. And I think the ability to be agnostic and be across all the platforms is going to be critical.
Hey, Rob, I wanted to ask you, and we're showing some of the competitors up there on the screen or other names that are in this space. How do you get that edge when it is more and more crowded? When you talk about the fact that the industry certainly seems like it's going under a bit of a transformation process when we talk about moving away from the massive spending that we've seen over the last several years. How do you find that niche?
Well, I think it's twofold, right? We're very, very selective. You probably, for any of you listened to my interviews previously, I talk about my team runs the company like Moneyball. So if you ever saw the movie Moneyball, we really run it almost like a hedge fund, right? We are very careful and very selective, and we try to find that niche between sort of 50,000 and 500,000 downloads, right? And we'll grow that now, right? Now will be the first time we'll have an opportunity to get podcasts, and you're starting to see that come over on a regular basis, who are doing 1 million, but we fill that niche where the creator really needs the full support. And I think what's happened is, the larger places, right, for them to manage those smaller creators is really difficult. And that's why one of the great parts of this is that our competitors are also our partners. Mm-hmm. And we're going to continue to do that and continue to work with them. And who knows, down the line, they could be a strategic investor or a buyer. And I fully believe that this cycle will come back in 12 to 24 months. And those same buyers are going to be even bigger buyers next time because the TAM on this is so big. And one of my biggest investors said, he was at an event of ours Tuesday night. He said to me, he goes, you know what the biggest problem in podcasting is? There's so much great content, there's not enough hours in the day to cover it. So I have to cut back the number of podcasts I choose. And I think it's a medium that's going to grow dramatically.
Yeah, Rob, I'm going to attest to that. I have so many favorites in podcasting. I feel like I don't have enough hours in the day. But, you mentioned we're still in the early innings. There's another wave coming. What do you think is going to drive that? Is it about the Joe Rogan style podcast? Is it about storytelling? Is it the fictional scripted content? What do you think is going to be the big catalyst to move this even further?
Yeah, so such a great question. I mean, we're a very powerful community and network in driving our podcasts across each other's podcasts, using that community to grow. I think it's going to be a little bit everything, right? Laura Martin over at Needham always described our company from all the great things we did in music, and we're just starting to hit this in podcasting, right? I've only owned the company for 3 years, right? In that 3 years, we took it from about 20 million in revenues, losing a lot of money, to where now it's going to do over $50 million and be very, very EBITDA positive, right? And the reason for that is we've got the team in place, we've got the management, we're starting to hit that critical mass, and you really don't need any additional infrastructure. You really have no additional costs. And what I see happening is multiple revenue streams. YouTube has changed the dynamics completely. You now have video. So you don't have just audio, you have video coming in. Next, you're going to have, and you probably know, my background in owning Atmosphere Films and having the movie 300 and did, billions in revenues and Spiderwick Chronicles, and Patrick Waxberger, who sits on my board and just winning Academy Award. We have a passion around turning these podcasts into television and film. And if you could hit that second window, you could have one or two pieces of IP that you control and own could turn out bigger than the entire network in revenues and bottom line. And then products. Just look at what Logan Paul is doing with Prime. It's truly amazing. He uses his podcast very much like my brother did in Entourage when he used Avion, right? There really wasn't, you weren't marketing or presenting it. It was integrated into the content. And if we can keep doing that, you're going to see more and more products launched from our company. I love the live side of the business, right? Watching Adam Carolla a couple of weeks ago do his live show. And the first live show we did with him, he asked us to put 3 of his favorite country artists on. Shockingly, we pulled off all 3, and 1 million people watched, and it didn't affect 1 piece of traffic on the audio. So I think there's very unique dynamics of new revenue streams that come from podcasting. And again, as those habitual behavior of the consumer, my kids are 29, 27, 21, my oldest kids. I have a younger one, my 3 older kids. So much of their time has been used to podcasts, and I think it's going to continue to grow.
Certainly, a lot of my time is used towards podcasts too. All right, Rob Ellen, great to have you. Thanks so much for coming in studio, CEO and chairman of Live One. Coming up, we've got the closing bell on Wall Street. Keep it right here. We'll be right back.
Awesome. So nice to meet you.
And that's the closing bell on Wall Street. Doing a quick check of the markets sponsored by Tasty Trade. All 3 of the major averages, at least for the day, eking out gains. You have the Dow closing up just around 80 points. S&P up about 0.1%. The Nasdaq back in positive territory, snapping a 4-day losing streak, as we did see Apple also close to the upside here. The Nasdaq up just about 0.1%. Let's take a look at some individual movers. And first up, shares of Block, the payments platform, in the red after experiencing widespread outages over the last 2 days. Many sellers were not able to access the platform and therefore could not process their payment. Service has now been restored, but it has done little here for the stock, closing the day off just about 5%. And Nikiko, we saw shares fall to the lowest level that we've seen since last year, since about November. And you talk about the fact that Block has had some trouble already this year. The stock in the red since the start of the year, well off, about 80% off the highs that we saw back in 2021. So obviously a bit of a concern here for investors.
Yeah, and Sean, on a personal level, I saw the impact, right? There are millions of small businesses that use that white square as we know it to process payments. And so many of them had to turn to cash because of that shutdown. So certainly a widespread impact. Yes, things have been restored, but Block releasing, or Square, I should say, releasing a statement saying once the outage has been fully investigated, we plan to publish a full review of this issue and determine what steps we can take to prevent it from happening. Worth noting, the Cash App, also owned by Block, also experienced an outage. So certainly not a good look at a time when we have seen that stock really pull back in a big way. And again, worth repeating, that stock at its lowest close since October of last year. Shares of Kroger are closing the day in the green despite the grocer seeing sales come in below expectations in the second quarter. The company also announcing a $1.4 billion opioid claim settlement. Investors, though, rallied behind the announcement that Kroger is selling more than 400 stores to CNS wholesale grocers. It's interesting to me. This is kind of the latest company to report that write-down that comes from that opioid settlement. But at least for today, it does seem like those 400 stores being sold off certainly what investors are focusing on while we're seeing that stock up more than 3%.
Yeah, certainly. And I think that payment and the fact that inflation still very much a challenge here for these consumer-facing companies. They were a little bit cautious here in their guidance, but you're right. The news of the fact that they're planning to divest more than 400 stores to C&S wholesale grocers really is what's driving today's price action, at least. And Kroger, this is just the latest step, right? Doing everything they can to get regulatory approval for that $24.6 billion deal with Albertsons. I was going through some Wall Street commentary here, and Bernstein out with a note saying that this is the first tangible signal that a successful outcome of the Albertsons deal closing is near. So optimistic tone there from the street. We'll see whether or not they are able to get approval for their deal. Again, almost a $25 billion deal. All right, well, RH shares selling off today after CEO Gary Friedman warning about more trouble ahead. He also doesn't see the environment stabilizing until next year. It pointed to weakness in the housing sector, higher mortgage rates at the highest level that we've seen in just about 20 years, significantly slowing activity within the housing sector, and that trickling down to what the activity RH is seeing. I guess people are not moving. They're less likely then to go out to RH, Restoration Hardware, as many people know it, and buy new furniture. So they're clearly having a very tough time at Kiko. The stock closing off just about 15%. But on the second quarter earnings report, when you take a look at the top and bottom line numbers, the numbers were pretty decent. So it's that cautious commentary here that's really driving the direction of shares today.
Yeah, it is really about the outlook. You pointed to what we heard from the company. The company now operating under the basis that current rates are likely to remain unchanged until the second quarter of 2024. So, this is a company that competes right at the heart of that luxury housing market. Things certainly haven't been looking good. And we've talked so much about that discretionary spending being pulled back. RH really at the center of that as well. So that stock now more than 15% today on the back of those numbers.
All right, well, coming up next, Apple shares under pressure this week as China is reportedly seeking to broaden its iPhone ban. We will discuss on the other side.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
Now, I got a question. What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again. Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
The 2023 NFL season kicking off last night with a close game between the Detroit Lions and the Kansas City Chiefs, and it is expected to be a record year for the sports betting industry. 73 million Americans planning to bet this season. That's up over 50% from a year ago. For more on this, I want to bring in DraftKings co-founder and CEO Jason Robbins alongside our very own Josh Schaefer. Well, Jason, it's great to have you here. Thanks so much for joining us once again as we kick off this NFL season. I know the season is extremely important to you, but give us a sense of the activity that you saw on your platform last night and what that really signals for the season ahead.
I mean, it was another record year to start NFL. Really just huge year-over-year growth. Sunday is going to be even bigger, but very exciting to see. There were a lot of new customers that came in, a lot of existing customers that deactivated at the end of last NFL season, came back. So really, pleased with the start.
Jason, you ran a promotion last night where if a bettor were to bet on the Lions to win or to bet on the Chiefs to win and they opted in the promotion, as long as that team got up by 7, the bettor gets cashed out early. So both sides of that bet actually cashed out. Even people that bet on the Chiefs, if they bet and opted into that, they cashed out. How does that process work when coming up with those promotions? And at what point does that promotion become too good because you guys have to pay out both sides of that bet?
Well, I think that one in particular is cool because you do end up where you can pay out both sides. So it can be expensive, but also for the bettor, you end up with people that no matter which side they bet, they won. And it's also pretty cool if you feel like, hey, I just snuck that in by 7 points. If it had been 8 points, it wouldn't have made it. So we like that. I mean, listen, promotions, there's a certain budget that we have for them. We like to do it in a way that gets maximum engagement from the customer. So this one, seems to be one that people like. We did it last year and people really responded well. So we brought it back. And it's always fun when it hits on the first game. I think that'll create some nice buzz.
And Jason, another sort of trend we're watching going into this season is there's some new entrants coming into the sports gambling market, right? We've got Fanatics coming in. ESPN's going to be getting in with a deal with Penn. I'm curious how you keep dominating that market share and stay atop the market share as you guys have over the year. You've gained market share just through 2023 alone. How do you keep market share with new entrants coming in? Is it those promotions or what sort of levers do you think you can pull?
Well, I think really we just have to do the best job executing across product and customer experience. And I feel like that wins the day. Obviously, there's a lot of other things as a business we need to do well. We need to be very analytically driven in our marketing. We need to make smart decisions across all groups. But I think that people will really gravitate over the long run. We've seen this in pretty much every digital product in existence, that best product wins. Because, on the internet, it's easy to compare. And so people talk and they see. And I think that we've really invested there. And I think at this point in time, I think we have the best product in the market and it's only going to get better. So what I tell the team is you just got to stay ahead of everybody. There's going to be guess what? It's a valuable space. So there will be competition coming in. People are going to want to see what we've been doing and copy it. So we need to be on to the next thing and the next thing. And we need to be doing it faster and at a higher quality level. And more than anything, we need to be keeping the customer at the center and making sure that we're giving them what they want and giving them the best experience. And if we do those things, I think we can beat any competition. And I look at it, we're barely a little bit above 30% market share. That's almost 70% of the, share, I should say GGR share. That's almost 70% still out there to get. So we feel like we have a lot of upside. And we can compete with anybody. And, listen, it's always going to be new competitors coming. Even if you look at, more mature markets, there's always, competitors coming, competitors leaving. And that's just part of being in a competitive space. But I think it brings out the best in the customer experience. And that's really what you want. So, like anything, like sports, we just got to be better than the other players on the field.
Jason, there certainly has been a focus when it comes to DraftKings and really other players within the space about getting to profitability. And when you talk about those incentives, how do you strike that balance, right, between offering incentives so you're growing your business, but then on the other hand, not overspending?
Well, I think there's a few things. First, a lot of the incentive cost comes during the customer acquisition phase. So just naturally, as time goes on, that comes down. If you look at our more mature state cohorts, we've shared some data on this. That rate just naturally comes down, even if we don't optimize anything, just because there's less new customer promos once you're in a market for a little while. Meaning the promos are still there, but as a percentage of your revenue, as a portion of your customer base, existing customers make up more. The other piece is we're constantly optimizing. We're always looking to say, the early win example you brought up earlier, how can we take that budget and do more with it? So we've already told the team, look, as time goes on, it comes down. At a certain point it won't, it'll hit a plateau, but it's going to come down. So you have to be figuring out along the way how you get more impact for the dollars that we're spending. And I think the team's really risen to the occasion. They've tested a ton. We're constantly testing things. We have a great engine for testing and optimizing. And so I think that's really the secret. But the nice thing is that there is that natural tailwind. No matter what state you look at, as it matures, marketing expense comes down, promo expense comes down, revenue keeps growing. And therefore, you get this inflection in contribution profit that really is more than just the revenue or player growth.
Jason, I have another promo question for you because I'm always getting this question from people. It seems like whenever there's something promoted before the game, especially if it comes up right before the game, like say last night, Kelsey's out, maybe a prop bet on Mahomes to throw over under 250 yards. And for the first time, and it feels like forever, Patrick Mahomes doesn't throw for over 250 yards. How are you guys so good at the pricing? How is that happening in that way that you can promo that so perfectly where it feels like it's a no-brainer? Patrick Mahomes over 250 yards. I think all of us would take it. Shauna would take it.
Even I would take it. I'd fall for it.
It sounds so good, and then it doesn't hit feels like the first time in forever. How's that work?
Well, people bet on both sides of it, so we lost on it too. But I think really, we're just trying to set the most accurate lines, and we have teams that really, spend night and day building models, making adjustments as they see, activity in the market. So, it's a very complex and mathematically driven operation. But there's also a lot of people involved too, making decisions along the way. And generally speaking, on a lot of those things, there's also a market. If you look around, you're not going to see drastically different pregame lines for most of the major players anyway. So, that's an element of it too, as the market kind of gravitates to where the betting is and where ultimately the line should be.
All right, Jason Robbins, always great to have you, CEO of DraftKings. Thanks so much for hopping on with us. And of course, our thanks to Josh as well. Let's do a check of the markets. Check out where things closed today. Sponsored by Tasty Trade. All three of the major averages for the day closing to the upside. You had the Dow up just about 75 points, S&P back in positive territory, and the Nasdaq notching its first gain of the week, closing up just about 12 points. Still to come, why haven't rising interest rates impacted the demand for buyers? We're going to be diving into the latest retail realities on the other side. Stick around.
Seoul, South Korea is a city of many colors, many styles, and many flavors. And seemingly everywhere you turn in Seoul, you'll see Samsung, a company that does, well, many things. It makes semiconductors and TVs, cargo ships and refrigerators. They even sell insurance. But they're best known for producing one of the most dominant lines of smartphones in the world, right up there next to Apple. Yes, Samsung does many things.
But one thing Samsung does not do often is invite tech journalists to the very factories where these futuristic phones are made. Until now. I'm Dan Howley, and this is What's Next with Samsung.
Okay, it's 3:30 a.m. New York time. We're going to Seoul, South Korea to go hands-on with Samsung's new Galaxy Z Flip 5 and Galaxy Z Fold 5. But maybe even more exciting is the fact that we're also going to Samsung's factory where they build their latest foldable phones. That's pretty cool. There's more to the story. First, I need a coffee though. Okay, so here's the broader picture. The smartphone in your pocket hasn't changed for years. Sure, its camera and processor take better photos and are more powerful, but overall, it's still the same black rectangle that you've always had. And that's what Samsung is trying to change with its newest foldable phones. But changing people's habits can be difficult, especially when it comes to their most important gadget.
Yeah, the biggest difficulty is a multi-trillion-dollar company called Apple. It comes down to one application, iMessage. When Americans got hooked on iMessage, we just couldn't get off. But yeah, it's iMessage.
But there's reason to believe Samsung could be the company to inspire a larger move towards foldables, even if that ultimately means inspiring Apple to follow suit.
But I do think Apple is closely watching Samsung. I think they're closely watching foldable displays. And they're also waiting, quite honestly, till there's a manufacturer who can produce enough of them for Apple.
For years, Samsung has stayed ahead of the curve, outfitting their phones with wireless charging, massive displays, well before Apple was doing any of that. And that history of innovation continues with the Z Flip and Z Fold lines, which are now, and this is important, in their 5th generation. That kind of commitment by Samsung is worth noting, especially when you consider their global market share and influence. A 15-hour flight is a good chance to talk through some numbers. According to Counterpoint Research, global smartphone revenue hit $409 billion in 2022, down from $450 billion in 2021. In Q1 2023, Samsung controlled 22% of the market, a virtual tie with Apple's 21%. In the US, Apple dominates with 57% of the market. Samsung, according to StatCounter, has just 27%. But in South Korea, it's a different story.
Here in South Korea, Samsung controls 63% of the smartphone market. Apple, just 31%. And it's pretty clear the moment you step off your plane, pretty much everyone's using a Samsung smartphone, kind of like a Samsung press event.
Yeah, so we're touring Samsung's facilities during the rainy season in South Korea. It also happens to be incredibly humid. I am acclimated to New York, so I'm basically just wet all the time. I'm a big old sweaty baby. We're going to take a bus now over to Samsung's Digital City. It's basically a massive campus. I mean, calling it a city is the right thing. Let's go. I've been to Google's campus, huge. Apple's campus, huge. This is right up there with both of those. So I'm here at the tour of Samsung's facilities. We're going to go get a deeper look at some of their R&D stuff. And you can see these huge buildings behind me. These are all Samsung buildings. This is just part of the complex here. It's a big kind of to-do that we're getting this access to the facilities. We won't be able to film the more sensitive areas, but still we'll be able to get a look, and then I'll be able to write about it. So stay tuned. We just got out of Samsung's quality assurance lab, basically showing how they test all of their devices. We saw different types of machines that they kind of run the actual foldables through, as well as their watches. Different types of drop tests, tumbler tests, different types of ways they drop it on different surfaces. Heat, humidity, cold, water submersion, anechoic chambers. I got to go in one, which is always fun. And really, this is a part of Samsung's broader push to show that these are kind of the future for their smartphone line. Hey, we're heading down on the subway. We're going to go check out Gangnam, where I also happen to be staying because I'm bougie like that. Which way? We got to get that. It's like 100,000% humidity, I think. I've been on this train for 5 minutes, and I've already spotted 5 people with foldable phones, whether they're the Z Fold or the Z Flip. People are using them here a lot. We're gonna go check out the new Z Fold 5 and Z Flip 5, get some hands-on with those bad boys and see what they're all about. So this is what we're here for. This is the Galaxy Z Flip 5, and this is the Galaxy Z Fold 5. They're slick, fancy, have new hinges, but they're also pretty pricey. Starting at $999 for the Flip and $1799 for the Fold, they're also competing with Google's new Pixel Fold and Motorola's Razr Plus, as well as a handful of Chinese foldables. As of now, Apple has yet to join the party. But as you might expect, manufacturing something like this is a bit more complicated than your standard candy bar style smartphone. So to see exactly how they're built, I got up at 5 a.m. to take a 3-hour bus ride from Seoul to Samsung's factory in Gumi. We're here on Samsung's Gumi campus. Basically, this is where they manufacture some of the biggest products that they sell, especially their smartphone line. You can hear the cicadas kind of going crazy in the background, but this is where they really do put together the smartphones that end up in people's hands. So let me sketch out what I saw inside for you. Inside Samsung's Gumi factory, the company pumps out everything from earbuds to tablets to smartphones. On one floor, custom-made robotic arms grab strips of printed circuit boards that are then filled with electronics components as small as 2 millimeters and passed through an oven to solder everything into place. On a separate floor, an assembly line of yellow Samsung-branded arms put together the company's Galaxy S23, while another line builds the Galaxy Z Fold 5. But what I mostly saw inside the factory was Samsung's massive commitment to foldable phones as its future. And that dedication was even more apparent during the company's Unpacked event. Samsung's foldable strategy provides the company with 2 things: a unique way to get consumers genuinely interested in smartphones again, and, more importantly, a means to combat arch-rival Apple. With its lineup of foldable phones, the company has something Apple doesn't: a new, exciting form factor that gets people talking. Nearly everyone I showed a Flip or Fold to was immediately impressed with the phone's design and styling. And the company isn't stopping there. Samsung executives hinted at further building out their foldable phones in the future. Unfortunately, as you might expect, they didn't offer any concrete plans. After spending a week with Samsung, checking out its facilities and speaking to some of its representatives, it's clear the company sees foldables as its future. But does that mean that a foldable is in your future? Will you give up that stale black rectangle for something that bends? It's too difficult to tell. While Samsung and its Chinese competitors have embraced the form factor, Motorola now has its Razr Plus, and Google has the Pixel Fold. The one company that has yet to go for a foldable is Apple. In 2021, Bloomberg's Mark Gurman said the company was exploring the kind of technology to make a foldable iPhone. More recently, though, he said they're focusing on an iPad. If, however, Apple does come out with a foldable iPhone and Samsung is still rocking it, then foldables may be the future. And that square rectangle in your pocket just might not be that long for this world.
So Samsung unveiling a foldable phone at its most recent event. Apple now set to debut the iPhone 15 next week in Cupertino. Dan Halley is back from South Korea, joining us here in studio. And Dan, my question to you is, that phone, I had a lot of questions going into it. It looks extremely impressive.
Yeah.
How much more pressure does that then put on Apple at this stage?
I think at this point, when it comes to foldables, it really comes down to the market share.
right? We're still at a point where it's not a significant market share compared to the broader smartphone market, right? We still have most people buying traditional candy bar phones. I mean, I have my iPhone on me somewhere, and it's a candy bar phone. So I think that's what we're really looking for is when you get to that threshold of people who are buying up these devices. Admittedly, they're still very expensive. Like I said in the piece, $1,000 to start. You can get an iPhone for less than $1,000. It's not going to be a Pro, it'll be a regular iPhone, but you're still getting something. And I think, it's going to take time for the pricing for these to come down. But while we were in South Korea, there were a number of kind of briefings that we had with Samsung executives, and they said, that's the goal, is to bring the pricing of these down. And it's clear that Samsung wants these to be the top of the line devices for them. These are what they're pushing to consumers now and what they want people to buy. It's sure they have their mainline Galaxy S series, but the foldables are what they want to represent Samsung going forward.
We heard from Bob O'Donnell kind of touch on this in your piece where he said with Apple, it is about finding the right manufacturer. And I wonder, when you think about where these trend lines have gone for smartphones, in many ways, Samsung has always been first, even if Apple has been about bringing this to the wider market. How much of that stems from the fact that Samsung owns so much of its own stack? They have the display, they have the chips, they have the batteries. Apple doesn't have that.
Yeah, I mean, it's a great point, and I think that has a good deal to do with it. Apple, obviously, they design things, but it's not their memory. It's they design the chip, but it's based on an ARM design, and it's manufactured by presumably TSMC. So as far as Samsung goes, their ability to do this kind of industrial design is incredible. I think they're also more likely, though, than Apple to simply take risks when it comes to design. The first foldable phones, when they originally came out, they were basically panned by reviewers because they had issues with them where the under display would get dust in it and it would pop up and you would ruin the phone. Some people thought that the display itself was one of those clear plastic covers that you peel off when you start using your phone, and it was part of the device, and they just ripped it off and ripped off the main screen. So that left a sour taste in people's mouths, and so that was part of the reason why when we were over there, you got to assume why Samsung showed us why or how durable these devices are now. And I don't think Apple is willing to take risks along those lines. Don't forget, when they came out, Samsung came out with the first Galaxy Note years ago, was one of the first big screen phones. People laughed at them, and now your iPhone is, more than 6 inches, 6.7 inches, if you have the larger variety. So they're willing to take the risks and take the hits, knowing that in the future, people will appreciate them and come forward. And then Apple says, okay, that works, we'll get on there. And then, they work their Apple magic and become huge sellers. So according to Mark Gurman at Bloomberg, they're working on that foldable iPad. We'll see if they eventually come out with a foldable iPhone, but I think it has to do a lot with the market share.
Would you switch after playing around with this phone?
If I didn't just spend $1,500 last year on a new Apple Watch and a new iPhone, yeah, I'd switch. But I was using the Flip for a while, and it's awesome. It's so cool to be able to just fold it down and then check out. Okay, I was doing walking directions around Seoul, and I got to close it up, just look at my map and then wander around. So it really is helpful. I think it's a great device. Battery life was cool, but I just sunk too much money into this stuff now. So I gotta wait.
It's hard to get out of the Apple ecosystem when you're in it.
Yeah.
I mean that's it, right? It's the ecosystem. I don't want to be that green text message.
I know. That's always.
I don't want to go. All right, Dan Hallett bringing us that story. Thanks so much for that. Well, Apple shares barely posting gains to end the week, but it was a tough week for Apple investors. The stock down 6% over concerns about an expanding Chinese government ban on iPhones. Looking ahead to next week, the question is whether the new iPhone will be enough to boost the stock. Joining us now is Angelo Zeno, CFRA Research Senior. equity analyst. Angelo, so many questions around Apple, but let's start with the moves that we saw this week. The sell-off coming from those headlines about China potentially banning the iPhone among government employees. But we also saw the release of this higher-end Huawei phone. What do you make of the sell-off, and how much of that has to do with the potential for the ban expanding? How much of it about is more competition coming domestically?
Yeah, listen, we definitely saw some negative headlines as far as kind of, the perceived impact it would have on Apple, right? And you kind of highlighted, the two situations this week very well. Now, on that side of things, I'd say kind of the bigger kind of negative implication would probably be on the greater competitive pressures out there, given kind of Huawei potentially re-entering the market at the high end of the market. With a very kind of, with a pretty good device, with that kind of made in China brand out there, which, clearly could potentially maybe drive some switchers back to that Android ecosystem from iOS, especially if you've got some of these, individuals that were working for state firms or agencies that can no longer kind of bring their iPhones into the office. But that said, I mean, on kind of higher level, we see very little impact from these news on Apple's revenue here over the next 12 to 18 months. So we wouldn't necessarily tell investors to react at all based on these news over the last couple of days.
Let me follow up on what you said about the potential competition happening in the Chinese market. Obviously, it's a big market for Apple. Nearly 20% of revenue comes from that market. And there's an interesting number out here from JP Morgan that shows Apple doubled its market share from 2019 through the first quarter of 2023 in the Chinese market. Not a coincidence. That's the time when Huawei faced export controls, some of the most stringent from the US. So now that Huawei has been able to prove that, yes, they have chips, maybe not on the level of Apple, but getting there closely, how much of that market share do you think they can chip back away or take back from Apple?
Yeah, no, I think that's a great point. So you kind of look at, where Apple and Huawei were just a couple of years ago, and I'd say kind of the biggest competitive threat back in 2018, 2019 to Apple was actually Huawei and not necessarily Samsung. And Huawei was really kind of gobbling up significant market share at that point in time. And we kind of just saw an abrupt halt because of the bans by the US government, which really kind of helped Apple out significantly. Now, that being said, in our view, Huawei probably isn't able to generate as much volume on this phone as I think many people anticipate they will be able to. And then also, SMI was really able to kind of crack the code here in terms of 7 nanometers. I think it'll be very difficult for them over the next kind of year or two to really see significant improvement on that side of things in terms of kind of the chip development, especially since we believe that the U.S. government probably gets back in and probably throws some additional restrictions into that region on semiconductors. So in our view, yes, it's a concern. It's a risk out there for investors as kind of the competitive pressures increase. But at the end of the day, it's very difficult, for the typical consumer to kind of migrate away from Apple and because of the stickiness of that ecosystem. And we do think most consumers out there that have an iPhone in China do love having that device. So we don't think it's going to have a huge impact in terms of the share shift, at least over the next 12 to 18 months.
Angela, let's talk about what we're going to hear from Apple next week. We're expecting a brand new iPhone, the iPhone 15. And there's been lots of questions just about whether or not this new device, if it's really going to blow away customer expectations, and whether or not it's going to be able to offset some of the weakness, some of the concern that we saw this week. What do you think?
Yeah, I mean, as far as kind of, typically you go into these events, right? And a lot of kind of has been leaked is already known, right? So, I think kind of, some of the big changes that are going to come here is clearly on the USB-C charging port in terms of some of the regulatory changes that have been forced upon by the EU. I think kind of all the biggest question mark as far as the event is concerned is definitely going to be on the pricing side of things. as far as the pro devices are concerned. I mean, and again, our view on the pro side of things is, you're going to get a shift in terms of towards titanium instead of stainless steel. That's going to kind of make these devices lighter. I think you probably see an increase in kind of the memory, given that we've seen more than 50% decline in memory prices here. I think that maybe helps entice or solidify a reasoning for increasing memory prices, the pro device price by $100. And of course, enhancements on the camera side of things is also going to be a big deal, especially on the Mac side of things. So all eyes are going to be on the Pro and whether or not Apple is actually going to finally go ahead and increase the price by $100.
So, Angelo, I guess from an investment case, is the best case scenario, that announcement coming next week, is it about a higher price point, even if it means fewer units sold, because that just adds up to the revenue?
Yeah, I mean, I think so. And the reason I say that is because, you kind of look at just replacement cycles. They've been kind of extending here for years. I mean, Apple hasn't necessarily been a unit-driven story, even though they have, taken some share here over the years. It has been more of kind of their ability to kind of sell that brand and increase prices steadily over time. If you look at over the last 15, 60 years on an annualized basis, when you kind of navigate through, the different ups and turns of these cycles, the average selling price is up about, 3.5% to 4% on an annualized basis over the last, 15 years or so. So Apple has historically been able to kind of put more great content into these devices, and because of their brand, been able to kind of incrementally increase prices over time. And they've been able to do so in a very kind of strategic way. I mean, we saw last year what they did in terms of, pushing more of the content into the Pro devices. We saw them ditch the Mini and kind of, release the Plus device. So they've been naturally increasing the ASPs through different approaches. But in this kind of instance, we think it's finally time for them to increase the price by $100 on the Pro side of things.
CFRA's Angelo Zeno, appreciate you joining us today. Tuesday, the big event we'll all be watching. Thanks so much.
Great. Thanks, Fanny.
Coming up, a major drought has caused the Panama Canal's water levels to hit historic lows. It could soon cause a whirlwind of headaches for consumers. We'll have more on that when Yahoo Finance returns.
Good morning. This is Yahoo Finance.
Big news. 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again. Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
The U.S. housing sector is currently plagued by high interest rates, mortgage rates ticking down slightly the past couple of weeks, but they do remain above 7%. Meanwhile, demand, though, for homes is still high. One economist thinks that boomers may be to blame here. Yahoo Finance's Danny Romero has that story for us. Danny, what's going on? Why should we be upset with the boomers?
Shauna, millennials may have another beef with boomers, and this time it's about the housing shortage. In a note from Barclays Research, one housing economist is pointing the finger at boomers and saying that this group is one of the factors weighing the housing market. Why? Well, boomers are taking up a bigger share of the housing inventory than the previous generation. The argument that they make is that the older you get, And the more likely you hit that retirement age, you become the head of a household. And for boomers, you're more likely to become the single head of the household, as some of these boomers inevitably lose their life partner. The difference, though, from now and then is that there is a lot more boomers than the previous generation, which means that there's more housing demand coming from them, leaving the younger generation, especially millennials, with fewer options. The upside, though, is that the population of the younger generation is a lot smaller than the boomer generation, signaling that the current demand dynamics that we are seeing right now will less likely persist in the future. Where does this all leave home prices? Well, Barclays expects that housing demand will still remain robust and new home construction will help supply, also bring some of those home prices down. They are expecting prices to likely to drop slowly, reaching an increase of 2.5%. But if the Fed does cut rates next year, that could spur up some more demand in the future.
All right, Danny Romero, great stuff. Thanks.
Well, drought in the Panama Canal may soon mean higher costs for consumers. Unseasonably dry weather in the region has caused low water levels in the canal, creating a traffic jam of container ships between the Atlantic and Pacific Oceans. The high costs that are being incurred as a result may eventually be passed down to consumers. Joining us now to discuss, we've got Mark Russo, the Chief Science Officer of the supply chain analysis company Everstream. Also to talk about the impact it could have on retail, we've got Steve Lamar, the CEO of American Apparel and Footwear Association. Good to talk to both of you today. Mark, let's start with you on the conditions that are currently underway on the Panama Canal. We kind of touched on it. There's a drought going, but give me a sense of how it compares to years past, how normally things are.
Well, this is the worst drought that we're seeing since the turn of the century across Panama. And while Panama sees drought periodically, it's not that uncommon, but the drought this year is definitely the worst here, especially during the months of March through August. In fact, this is the lowest rainfall totals that we've seen during this time frame since the year 2000. And as a result of that, combined with warmer than normal air temperatures, that has resulted in higher evaporation rates and now ultimately the lowest water levels on Lake Gatun, which feeds the Panama Canal. And fresh water is the lifeblood of the Panama Canal and driven by rainwater, especially during the rainy season. But because of the drought, that is now lacking, and that is how we've got up to this point.
So, Steve, what does this then mean for retailers out there, for those who are trying to get their goods up through the canal? How big of a risk could this potentially be?
Well, we're watching it very closely. You know, the Panama Canal is a major part of the shift from West Coast to East Coast as companies have been trying to reconcile supply chains over the last couple of years to account for some of the previous disruptions that we've been having. And now the East Coast represents about 50% of our business. So as more business has been coming through the Panama Canal, certainly disruptions in the canal are going to create more risks. And of course, they've announced there's going to be more restrictions that are going to last for the bulk of next year as well. But all that said, the impact may be muted, at least in the short term, because consumer demand is certainly not as strong, not as wild as it was last year. There's still inventory that people have that they're working their way through, and a lot of our goods, when they're shipped through the canal, they're shipped on pre-booked containers, so they do have some ability to gain priority to transit the canal. But all that said, if consumer demand gets a lot stronger, if the restrictions cut even deeper, you could see more disruptions, which, again, when you see disruptions, it's delays or it becomes price increases or cost increases that become price increases.
Steve, what are some of the contingency plans members are considering? What are the alternatives?
Well, alternatives are you're really looking at shipping routes that take you, if you're sort of in the India range, now you're looking for the Suez Canal. That may take you a little bit longer, but that does create some options. People have been in the middle of sourcing diversification, so they're diversifying away from traditional Asian suppliers in China and say Vietnam, so relying on locations closer to home, either Central America, for example, Africa, other locations that might have different routes that would feed directly to the East Coast without going through the Panama Canal. But I'd say one of the other contingencies that we're dealing with or working on is kind of the bigger problem here is that the problems the Panama Canal is facing is another reminder that climate change continues to be a big issue for not only our globe, our economy, but for our industry and our supply chains. And so there's a lot of work that's being done to make sure those supply chains and the production patterns are done in a more responsible, sustainable measure.
Steve, when it comes to what has transpired over the last several years, we know a lot of retailers have certainly had a tough time getting their goods and getting it in a timely manner. How has that process shifted? And I guess, how do they navigate a situation like this? How much of that has changed since what we were seeing pre-pandemic?
Well, the big place where the process shifted is a lot of trade migrated from the West Coast to the East Coast. There was a overdependence on the West Coast, and of course that played out pretty strongly a number of times throughout the pandemic, most recently with the labor negotiations that were happening. The way that companies really resolve that is they build redundancy into that. So they might have longer term commitments, double commitments where they have patterns of trade that can take them into different kinds of ports that they might not have been using. And that way, if there's a problem with one transit hub or one port, they have a backup and they can use that as well. And that was certainly one of the lessons that people learned and people have really been pretty aggressively implementing in the last couple of years.
Mark, is there any relief in the forecast? I mean, are we likely to see any improvements in water levels?
Well, we don't see any improvement right now in the short term. Over the next month or so, see a continuation of below normal rainfall and above normal temperatures across much of Panama and Central America. But even beyond that, we think that things will continue to deteriorate even for later on this year, even potentially the early part of 2024. Reason for that is because of the El Nino event in the Pacific Ocean, and historically El Nino events, or these warm waters in the Central and Eastern Pacific Ocean, that has a strong correlation with below normal rainfall, especially during the months of December, January, and February. So as we move towards next dry season in Panama, and we're already seeing the wet season with below normal rainfall, we see things then getting worse. So bottom line, we do not see any significant improvement. And in fact, we see things getting worse from now through at least the end of the year.
Yeah, yet another reminder of the widespread impact we're seeing on climate change. Mark Russo and Steve Lamar, good to talk to both of you. Really appreciate the time.
Thank you.
Thank you.
Well, coming up, it is closing time here on Yahoo Finance. We're going to recap the top stories of the day and get you set up for everything you need to know going into next week. It is closing time here at Yahoo Finance. Here's a look at some of the top stories of the day. Stellantis now making an offer to the United Auto Workers Union just days before the current contract is set to expire. The automaker offered a 14.5% raise over 4 years. That's much higher than the offers from General Motors and Ford. The offer also includes one-time payments in the first year of the deal, making Juneteenth a paid company holiday. Elon Musk's X is suing the state of California over its content moderation law. The California law requires social media companies to explain how their content is moderated, but the company is arguing that the law violates its First Amendment rights. And finally, the Internal Revenue Service announcing a crackdown on 1,600 millionaires in an effort to collect back taxes. The head of the IRS says the agency will use artificial intelligence to help target wealthy Americans who have cut corners on their taxes.
Taking a look at what to watch next week. First up, Apple's big event where the tech giant is expected to launch its highly anticipated iPhone 15, the debut, coming after shares took a huge hit this week following reports that China is going to broaden its ban on iPhones for government employees and state businesses. Also get the latest check on inflation. CPI, the Fed's favorite measure, could give investors clues on future Fed policy. Prices did cool last month, but energy prices have jumped since then, potentially complicating the Fed's battle to tame inflation. And Thursday is the deadline for the UAW and the big three Detroit automakers to reach a deal in order to avoid a strike. Stellantis joining Ford and General Motors in offering the union significant wage increases in an effort to avoid a work stoppage. Stellantis' offer of a 14.5% increase is larger than its rivals. And all week, Yahoo Finance will help answer your student loan questions. We will be speaking with education and personal finance experts in a week-long series, Student Loans, Smarter Strategies. That kicks off Monday morning right here on Yahoo Finance. Well, that does it for us today and for the week. Thanks so much for sticking around. We'll see you right back here on Monday. Have a great weekend.